as a financial advisor, I see the same tax mistakes over and over again. And what kills me about them is that they are so avoidable. So I thought I'd put together a video for you where I walk through 7 of the most common tax mistakes I see, how you can avoid them so they can stop costing you. All right, so the way that we are going to do this is we are going to go from mild tax mistakes to the most expensive tax mistakes. So the ones that I mentioned towards the end of this video, I've actually seen cost some of my clients close to 6 figures, if not several 6 figures in taxes. Mistake number 1 is not understanding deductions. I cannot tell you how many people I meet or talk to who buy really expensive homes and they take out a huge mortgage and they'll say something like, well, at least the mortgage interest is tax deductible, right? Wrong. Most of the time. Most of the time, that's not right. You see, how it works is as a taxpayer, you have one of these deductions available to you. You're either going to take the standard deduction or the itemized deduction. So how do we know and how do we decide which one that you get? Well, the good news is you get whichever one is higher for you, which is good. But here's the thing you should know. Only 11% of people itemize deductions. Most people, 89% of people, take the standard deduction. This happens now because the 2017 Tax Cuts and Job Acts nearly doubled the standard deduction, making it way more difficult to itemize deductions. So here's the way it works. The standard deduction is a flat dollar amount, and it varies based on your tax filing status. Itemized deduction, on the other hand, is a list of deductions you have available to you. And what we do is we add them all up and we see if it beats that standard deduction number. A lot of deductions that we believe we have available to us actually fall under the itemized deductions category. Meaning, if you take the standard deduction, but you believe that you're deducting mortgage interest and some of these other deductions, you're actually not. Itemized deductions include mortgage interest, like we mentioned, also includes charitable contributions, state and local tax, medical expenses above a certain amount. These things are only deductible if you itemize. Mistake number 2 that I commonly see is missing out on workplace benefits. Almost nobody bothers to read through their employer handbook, but as a financial advisor, it's one of the first things I ask for from my clients. Because in these handbooks, there are a lot of opportunities to spend money pre-tax. I'm going to walk through just a few examples for you, but please get out that employer handbook, relax on a Saturday night and read through it.
2 very boring minutes later.
What I find in these employee handbooks is that a lot of employees have access to an HSA or an FSA. And these are healthcare accounts that allow you to pay for health expenses pre-tax. The health FSA, or flexible spending account, allows you at the beginning of the year to decide on an amount that you want to put into this account. Then the money comes out of your pay before taxes, and then you can use that money to pay for health expenses. This is great if you know that you have health expenses coming up in the current year. Personally, I used this account when I was an employee to pay for Invisalign without tax. And that makes a huge difference when you consider the tax savings you get just by funneling it through the FSA first. Now, the downside of the FSA is that money does not roll over. And if it does roll over, it's typically a small amount, like $500. So it's what we call a use it or lose it account. So if you put in $5,000 into the account at the beginning of the year and you end up only spending $1,000, you might lose that $4,000. So you have to be careful. It probably does not roll over into the next year. This is where my good friend, the HSA, steps in and is just a better account. The HSA probably is maybe my favorite account. I'm self-employed. I have access to one because I have a high deductible health plan. That's what's required with the HSA. So that might be your downside. I completely understand people out there that don't want a high deductible health plan, especially if they're going to the doctor a lot. But if it's something that makes sense for you, I love the HSA because it has a triple tax advantage. What this means is that money goes into the account pre-tax. You don't pay taxes on that money. That money grows tax-free and then eventually comes out tax-free for qualified medical expenses. The other great benefit is, unlike the FSA, your money rolls over every year. It is your account, it is your money, so you get to take it with you when or if you leave your employer. And one more perk, while it's in the account, you can actually invest the money so it can be growing tax-free for you. I love the HSA so much, I made an entire video dedicated to just this account. I'll link it up here. Mistake number 3 is losing track of your losses. If you sell an investment at a loss, you get to use that loss to your benefit. What I mean by that is that loss can actually be used to offset some of your gains and even your income. So to illustrate, let's say you have a regular brokerage account, and this account, let's say you own Tesla stock, and let's say you had really bad timing. So you purchased Tesla stock at its peak back in November 2021 for $400 a share. You put in $10,000 into Tesla, so you bought 25 shares. Fast forward to today, your shares have a 60% loss. So you decide, you know what, I'm done being an individual stock investor. I just want to get into index funds and forget about it. So you want to get out of your Tesla shares. Well, you're going to take a loss to do that. You sell them today for, let's say, $160 a share. So you have a $6,000 loss. Now, I know this may hurt, but here's the benefit. You can now use that $6,000 loss. You can use it against income. You can use it against gains as well. Continuing on with this example, while you're done being an individual stock investor, you want to get out of your other stocks. So let's say you also held Amazon. Your Amazon stock, unlike Tesla, actually has a slight gain. Let's say your Amazon stock has a $1,000 gain. Now, normally you'd be taxed on that gain from Amazon, but because you have $6,000 in losses, we can actually use $1,000 of those losses to offset the $1,000 gain, netting it to zero, no tax impact. But we're not done yet. You have $5,000 in loss left over. Well, you can also use $3,000 of those losses to offset your income every year. Now, there is no limit to offsetting gains. So if you actually had a $6,000 gain in Amazon, you would use that full $6,000 in losses and offset it against the Amazon stock. But there is a limit on deducting losses from your income. $3,000 is the limit. Now, here's where people make the mistake. After you offset your $1,000 gain from Amazon and your $3,000 in income, you've used $4,000 of your losses. You have $2,000 left over. That $2,000 in losses, it carries forward forever. Now, you'll probably use it all up next year to offset your income, but the important thing is to keep track of it. People lose track of this all the time. They switch accountants or accounting software, and that $2,000 in losses just disappears. I've seen this happen. You should be able to find your carry forward loss on Schedule D, or tell your new accountant, say, hey, I know I had losses last year. Here's my previous year's tax return. Can you check it for a carry forward loss? They should know exactly what to do. Important note here, this doesn't apply to losses in retirement accounts. If you sell a loser in your Roth IRA or your 401k, you don't get to use that loss. We're already getting a tax advantage in those accounts. Mistake number 4 is paying unnecessary tax in your brokerage account. This kind of piggybacks off of mistake number 3. We just covered how to deal with losses in your brokerage account. It's also really important to note how to deal with gains in this account. The brokerage account we sometimes call a taxable account because it is taxed as you go, but it's important to know that there are several ways to minimize your tax impact in this account. And honestly, it's not that hard to do, but people ignore it and they pay big tax bills in this account and their gains get interrupted by taxes just because they don't understand that they're getting taxed. Taxes in a brokerage account is so important to pay attention to because it's one of those things we have control over. So important, in fact, I did a super deep dive on this topic as well, all about taxes and investing. I'll link that video here. But what you need to know is that in this account, you are rewarded from a tax perspective for being a long-term investor because short-term gains and long-term gains are taxed 2 different ways. Short-term gains are taxed as ordinary income, while long-term gains are taxed at capital gains rates. We care about this because capital gain tax rates are lower than ordinary income tax rates. To illustrate, let's say you are in the 24% ordinary income tax bracket. you have a long-term investment with a $100,000 gain. Good for you. That's a great gain. And you sell it. Well, if you held that investment for 1 year or less, it is a short-term gain, and that's taxed at your ordinary income rate, which we just mentioned is 24%. So your federal tax is $24,000. Now let's say you've actually held this investment for over 1 year. Now it is long-term, and it's taxed as a capital gain, and your capital gains tax rate is 15%, not 24%. So now your tax is $15,000. That's a $9,000 difference just for holding the investment long term. And don't forget, we can use losses to offset these gains as well. Mistake number 5 is getting Roth timing wrong. Now, Roth accounts get a lot of attention, and for good reason. Tax-free growth, tax-free wealth is a great benefit. But if you're in a high tax bracket, choosing Roth over traditional could be a bad idea in the end. So I can't say for sure without knowing you and your situation, but often pre-tax contributions when you're in that higher tax bracket can make a lot of sense. So we can avoid the tax today and pay it later when you're hopefully in a lower tax bracket. Now, that doesn't mean to never do Roth. In fact, I see a lot of missed opportunities for high earners when they have low income years. I've worked with high earners where they may have a year where their income actually dips. So maybe they've made the leap to entrepreneurship, or maybe they get equity compensation, but there's a year where they didn't get any. When your income dips from that very top tax bracket to a lower tax bracket, you may want to consider switching from traditional to Roth contributions and taking advantage of being in a lower tax bracket. And if your income really dips, let's say you made a full transition to entrepreneurship, now your income is 0 and is expected to be really low for the entire year. It may even be time for Roth conversions. This is where we take money from traditional IRA and we convert it over to Roth. The point here is that we are trying to capture the low tax bracket when it presents itself to us. Mistake number 6 is spending money to get a write-off. Now, social media has made this problem a lot worse and a lot more common. Oh, I'll just buy this car and write it off. I'll open up an LLC even though I don't own a business. I'll use the LLC to buy things, and then I just get to write them all off. Don't do this.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah. It's when you buy something for your business and the government pays you back for it.
Oh.
1, you will get in trouble if you're not really a business owner. And 2, even as a business owner, write-offs are not free money. They are simply pre-tax money. If you spend $2,000 on a computer for your business, that is a legitimate business expense and it is deductible, but the cost is not $0. Assuming you're in the 32% bracket, the cost is $1,360 for that computer. You just saved on the taxes. And the problem extends just beyond business owners and people I see on TikTok. I notice a lot of people hear tax deduction and they think, oh, free money. Tax deduction just reduces your taxable income. Remember that. All right, mistake number 7 is really a bonus mistake. It doesn't apply to everybody, but I want to mention this one because we just completed a tax season and I saw a scary amount of people mess this one up. This one is not correctly reporting the backdoor Roth IRA. So this one's for my high earners who have to use the backdoor method to get money into a Roth account. Now, I love the backdoor Roth. It's a great strategy. But a very important step of the backdoor Roth is to file Form 8606 at tax time. This form is what prevents double taxation on your Roth conversion. If you did the backdoor Roth and you didn't tell your accountant that you did it, you're not done. Now, those are just 7 of the most common ones. It's certainly not all of them. I'm really curious if you have seen a bad tax mistake made either from yourself or somebody you know and what the outcome was. Let me know below in the comments.